I know Mark Minervini doesn't need an introduction, but I just want to make sure that he gets a proper one, because Mark, you're one of those legendary traders that I read about back in 1996, reading the Stock Market Wizards books. You are one of the probably most well-known traders around today. And so for those of you that don't know about Mark Minervini, he actually was the 1997 U.S. investing champion, but also, wasn't it just last year or 2 years ago?
2021.
2021. And so it's just really big honor to have you here. And Mark Ritchie the second, this is going to be your first time here at Traders Summit, and you're the managing partner at RTM Capital, but you're also featured in Momentum Masters with Mark Minervini, David Ryan, and Dan Zanger. So welcome to the Traders Summit for the very first time.
I think we have to update. I think we have to update Mark Ritchie's bio. He works for Minervini Private Access now for several years, and he also is my co-instructor at this year's Master Trader program. So, well, Mark has an incredible track record himself. That is a market wizard in his own right, and that's why he's works with our firm now. So, just wanted to make sure we update that.
All right. Well, I'm glad you did, and thank you. And I stand corrected. So, Mark, and now I'm going to have to do this. How are we going to do this? Mark M and Mark R. But I also brought one of my colleagues, Ryan Littlestone. He's originally from Forex Flow Live. He's a trader, ex-trader on the live floor. Him and I, we talk markets all day long, and we trade very actively between him and I through the European and North American session. So I brought him because I think this is a Traders Summit, and we're actually going to talk markets, but really I want to talk trading. And let's start with you, Mark Minervini, about your process in today's environment, because today's environment is obviously trickier for the investor, but from a volatility standpoint, us as investors, or excuse me, as traders, this is where we really thrive. So how has it changed your process from, let's just say, a year ago when we were in a low vol environment to now when we're a very high volatility environment? You have, you can trade both sides of the market, and, equities, both sides, almost any market, both sides. So how has your process changed?
Okay, well, there's a number of things about your question I'd like to address. Is number one, first of all, my process hasn't changed at all in over 30 years. So not 1% has my process changed in decades. And I'm sure Mark Ritchie is going to give you the same answer. He's been doing this lesser time than me, but he's over 12, 13 years himself. And another thing too that I have to, I think, you're saying a low vol environment versus a high volatility environment. This isn't really that high volatility. I mean, it's for individual stocks, there's a lot of whipsaws around breakouts and so forth. And maybe that's what you're referring to, because it is definitely too much volatility for someone like myself who likes to get in a very low risk entry, and I want the trade to work right away. And for me, yes, it is a relatively high volatility, but historically speaking, in a bear market, the VIX hasn't even really gotten much above 30 ever, and stayed below it most of the time. 30 is sort of the threshold that I look for that starts the high volatility environment that you get in a bear market. If you go back in 2021, which you alluded to, that I won the U.S. Investing Championship, it was a very difficult year. And about February, I saw a shift in what was happening, where you weren't getting those longer term moves and you're getting very short term moves from the breakouts. And I just made that adjustment, sold quicker into strength, and compounded a lot more rapidly. So that's the only shift that I've made, is just, within the confines of my strategy, just went to a little bit shorter term trading. And I'll tend to do that in the later stages of a bull market.
That makes a ton of sense. Let me ask you, Mark Ritchie. Now, he just alluded to the fact that your trading strategies really haven't changed a whole lot. But in your own words, how have you tackled this environment? And by the way, Mark Minervini, great observation on the VIX, especially not getting above 40. I think it was a little bit of a canary in the coal mine this week. But Mark Ritchie, let's hear it from you.
Like Mark said, nothing has changed in regard to process. That was your original question, So the way I'm screening the market and evaluating things has not changed at all. To Mark's point, the only change that was really warranted is sort of in tactics, where we had a really an 8-9 year bull market with some really short, intermediate type corrections, short cyclical bear markets. Where dip buying and that type of thing is, and really sloppy tactics, quite frankly, has been rewarded for a long period of time. I won't get into all the BTFD stuff that was going on Twitter for how long, but if you're going to trade on the long side over the last 12 to 18 months, like Mark was saying, you have to be extremely tight with both your profits and on the risk control, because the pivots have been a little sloppier. But if you're not quick in terms of taking profits into what strength we get, it just doesn't last. And I think that's just sort of classic. It's only gotten worse. It started, sort of middle to late last year and been harder and harder and harder. And that's kind of, you've seen a lot of the retail people and folks give up or throw in the towel on some of these sloppier tactics. But that's where I would say the only real change is to say, if you're going to be trading the long side, it's much harder to sort of be a position trader and trade for bigger moves.
Ryan?
Yeah, I mean, first and foremost, absolute pleasure to be among you two gentlemen. I saw you first last year, Mark, and, as a trader myself, just sitting and listening to your processes and sitting there going, yeah, tick, I do that. Yeah, tick, I do that. It was a wonderful interview. And I think both of you gentlemen are maybe underselling what you've just said in terms of your processes, because you said you make small adjustments based on the conditions. And I think that is a big thing for traders who don't know that, that you have your process. Every trader has their process. And a lot of traders have the same foundation for trading. You know how to manage your trade, get into a trade, get out, what to look for. And that should be automatic, if you like, amongst all traders. But making those little tiny adjustments, and you say they're very small, but for other traders, they could be very big, to know how to make those adjustments. Do you think that it is very important to know just to make those tiny little changes that cater for the current market conditions?
Well, you're right. Those tiny changes are what separates the great traders from everyone else. And they are at times big changes. And so the thing that I like to tell people is that, regardless of what strategy that you use, you have to stay true to the strategy. Otherwise, you don't have a strategy. Having a strategy is like having a marriage. If you cheat on your wife, you're probably not going to have a very good marriage, a good relationship. So you don't want to cheat on your strategy and try other strategies. You want to know everything you can about that strategy. So what Mark just said is very important, that we will adjust our tactics, but not our strategy. So you can be flexible with your observations. You can be flexible with what you see and the tactics that you apply, but you don't want to be flexible with your philosophy. That's assuming, of course, you have a strategy with an edge, you have a sound philosophy to begin with. We know we have a sound philosophy, we have a sound system, so we're true to it even in difficult environments. The quote unquote small changes that are really important, that I think what you're pointing out is that they're actually quite large, especially for the average trader, and something that Mark does really well, and I've done over my career. And I would say that is the real difference between us and a lot of other traders, is that we are willing to step on the gas and really slam it to the floor and make a lot of money when things are good, and ride the brake for long periods of time. And a lot of times, we'll be in cash, or we'll be recommending, to stay cautious for extended periods of time. How long are we going to do this? How long is it going to be before we get out of this market, before we can put money to work? And my answer is always the same: as long as it takes. So we'll wait and wait and wait, but we'll also shift very quickly when we see the whites of the eyes, when we see what we need to see. And that's the difference where a lot of people, amateurs are late to the game, and they're more reactive to the trends and things that are happening, too late. That's probably the big difference. I don't know how, Mark.
Yeah, go ahead, Ryan.
Yes, I was going to say to you, Mark, what's the how quickly can you see that you need to make those small changes? Because you see some traders who they have their strategy, it works, it doesn't start, or it starts not to work, and they keep pushing it and pushing it and pushing it, rather than saying, hang on, this was working a minute ago, it's not working now, I need to assess and change. So Mark Ritchie, how quickly do you get to see those points where you need to change?
Well, this is where I think tracking your trades is keeping a pulse on your actual results, and we use what we call kind of this trading triangle at MPA, where we teach stocks, tactics, and then the third one is feedback. What kind of feedback are you getting from your own trading? And that's going to be the tell often to say, oh my goodness, things are not working. Well, are you going to trade larger? But yet this is precisely what a lot of amateurs do. They trade larger at the wrong time and smaller at the wrong time. And what I was going to add, Ryan, I thought you made a good point, was the idea of, there's a lot of these little things. There's an old saying, it's the little things that kill. Well, the opposite is true in trading. Doing the little things right and incrementally getting better can have a monumental impact on your performance. This is exactly how someone goes from being a loser to a winner. They make these small, consistent little changes. Think, anybody who's been trading long enough knows what I'm talking about, where you go, if I can take a few of these small losses and make them smaller, and take some of my winners and make them bigger, where the novice goes, what does it matter if I buy sloppy 2% above the breakout, or give this stock a little more room to run? That's precisely what makes the difference between average and poor performance, or say maybe above average performance and super performance.
Yeah, if I could, Ryan, if I could just add something, because he brought up a really important point. Two things. One is that traders don't realize that you're not going to just make one trade. You're making hundreds of trades, thousands of trades over a career. So as Mark just said, when you are these little things, they add up over time. It's just like in poker. They call it saving bets. If you go over and you every now and then you throw an extra nickel in, you throw an extra quarter in there. When you go back and you were if you were to go back and do post analysis of most amateur poker players, you'll find that where they really go wrong is that they just give away a whole bunch of chips on all these bets that they shouldn't be calling, on raises they shouldn't be calling, on things they shouldn't be doing. So saving bets would literally make the difference between them being profitable and unprofitable. And what Ryan was asking was about gauging. And the mistake that we find that a lot of people do, amateur and professional, is they gauge by the indexes. So now you're a stock trader, and now when the S&P starts taking off, the NASDAQ, and it gets oversold, you're trying to jump into stocks, when in fact, I always say, you can just look at the indexes as the store, and the stocks as merchandise. The store's open, the lights are on, the sign says, come on in, we're open. You go in the store, and there's nothing on the shelves to buy. There's no merchandise. You came there for bread and peas and carrots, and it's not there. So we do just the opposite. We let the stocks guide us. And if the Dow took off right now and went up 30%, if there were no stocks that met our criteria, we'd stay in cash, and it wouldn't phase us in the least. So, but to the average person, they'd go, oh my God, I'm missing it. They would deviate from their strategy and cave in and start buying something because they feel like they're missing the market. So it's your definition of what the market is and where your strategy is. You got to keep your eye on the ball, know what ball is your ball. Stay in your lane, if you will.
That's great response. I've got a question that I'm going to direct it more to Mark Ritchie, but Mark Minervini, obviously, I'd love to hear your thoughts on this too. Sure. What do you guys say to because the reason why I say this is Mark Ritchie managing money, other people's money at different points in your career versus Mark, maybe trading your own capital. What do you say to those professional traders like myself? I traded for a firm, boutique firm out of the Northeast for many years, and I was always up against a quarter, a month end, quarter end, and you meet professionals, they're like, shoot, at quarter end, I've got to really make up some P&L here. How do you direct or guide those more professional traders that find themselves up against a time horizon where if they don't make it, maybe they're not going to get a big bonus for quarter end or year end or what may be. How do you attack that?
Well, just for starters, we'll say I'm not managing money publicly anymore, so no one please reach out to me in that regard. I would say nothing changes. That is a gigantic red herring. Why would you change your criteria based upon an arbitrary, month-end quarterly mark? This is precisely, I would say, what you don't want to do, and where traders or managers get themselves, whether they're managing their own money or public money, get themselves into trouble. I think sticking to the criteria is the only way to go. Meaning, if there's nothing to trade, I understand the pressure in terms of what, I want to get a bonus, but that's a recipe, in my opinion, for disaster, or for veering well outside of either your area of competence, or your initial strategy. And the other thing I will say, though, this is where individual traders have an enormous advantage over lots of different professional money managers, because they have these mandates where the individual does not. Maybe they have to be, a certain percent invested, or they can't use cash tactically the way Mark and I do as a position, and where you can get really aggressive in periods of time. That is a tremendous advantage. And there's this gigantic myth out there that says the professional money managers have the huge advantage over the individual. I think it's precisely the opposite. Great response. Mark Minervini, you want to join in there?
Blake, and just want to say, you guys are asking some really great questions, because they're really stoking a lot of responses in my mind. So first of all, I always said, Wall Street is all the wrong people and all the wrong principles in all the right places. So you just highlighted that. This is where you have this incentive that is not aligned with the investor. So that's why the hedge fund model works so well, because people, you make money, they get a piece of the profits and so forth. And precisely, I managed money for other people many decades ago. Was for a short period of time. I was very successful with it, and a lot of money was offered to me. I turned down hundreds of millions of dollars when $100 million was a lot of money. And I'll tell you exactly what happened. I would say to investors, let me ask you a question. What would be an acceptable return? If I could make you 20% a year, 25% a year with very little drawdown, would that be acceptable? They'd say, oh, wow, yeah, that would be great. Okay, great. Let me ask you another question. If I were to say that I'm going to guarantee you that in 5 years, I'm going to make you 20% a year. But let's say that I went 4 years where I did nothing and I made it all in the last year. Would that be acceptable? They say, yeah, sure, I guess so. No problem. Okay. Then guess what? 2 months after the accounts opened and the Dow goes up 10%, I'm getting phone calls. What the hell's going on here? How come you're not making money? Well, wait a minute. What happened to the 5-year plan? I thought I had 4 years to do nothing. So, right. So as soon as those indexes start taking off, and their uncle and their friend and their next door neighbors doing well, and the favorite mutual funds taking off, it all goes out the window. All the discipline, all the plans, they go all out the window. And that's the difference between professionals and amateurs, and champions and everybody else. Champions are disciplined, and discipline is a principle of greatness in anything. So yeah, I mean, that's why, again, you have to align. Everything's got to be aligned with your own interest, with not only for managing money, with the interest of the client, but when you're trading yourself, you have to learn how to align your own interest and not come out, like I said, out of your own lane and start sabotaging yourself just simply because, these factors are happening that are what I call noise, all this outside noise. And with the internet and social media now, there's more noise than ever. So the real job, the job is minimizing all this noise. It's very difficult.
Before Ryan, we move into the next question, I'm gonna take a step back, and I just want to let everybody know. Remember, we're at the Trader Summit, and we don't often get an opportunity to speak to Mark Ritchie the second, or Mark Minervini, and this is your opportunity to also ask some questions. I've got some questions that have come in throughout the course of the last a few hours, because people are like, "When's Mark coming?" Oh, here's my question. So I've got a couple questions, but make sure you get yours in. We're not going to get to them all, but this is a great opportunity to have these two legends here. So Ryan, to you.
Yeah, I wanted to ask another question. We're talking processes, targets. Targets for when you're trading. Personally, I don't trade with target. When I start a trade, when I look at a trade, I don't think about a target. I don't think this is where I want it to go to. I take care of my risk first. Where it goes after that, I try and run the trade wherever. I have points where if a price gets to a certain level, something may happen. Might need to make a decision, take profit, wait a bit, that sort of thing. How important do you place in targets, or what importance do you place in targets, you two gentlemen? Is it something that really factors, or you just want to push a trade as far as it goes until maybe it hits a point where you think, okay, that's the time?
Okay, so I'll answer that. I just want to say real quick, because I actually just clicked on the chat box real quick, and I saw someone just alluding to that, having a debate here between Mark Ritchie and myself, which I just want to make sure everybody understands. Mark Ritchie is my right-hand man on a daily basis, and he's probably the only person in the world that I would give my personal money to. So, because the reason why is because he's going to make every move almost identically to me. We are literally like a right hand and a left hand. So there would definitely be, I don't think we've ever debate ever about stock trading.
I was going to let you do a mic drop if you could do that here in a second, but
yeah, you're not going to hear a debate between us, that's for sure. A lot of repetitiveness, probably. It might be boring. As far as targets, Mark and I, we don't never use targets. I don't ever have a target on a stock. Thinking it's going to go here. I might have an idea of what I think it will do, but we don't set targets and then sell because it hits that target. I just stay with the stock, and when the stock, I'm trying to assess when reward outweighs risk in the beginning of the trade, and then as the trade progresses, when it starts to shift, where now the risk outweighs the reward, and the risk of it, declining is greater than it moving up higher, and then that's where I'm selling it. So, and again, this isn't as much fundamentally based as it is technically based usually. I mean, there is, if a bad earnings report comes out and there's a bad response to the stock and so forth, yes, fundamentals will come in play, and certainly that's a part of it. But usually our selling the stock is based on, on the technicals and our profit versus what we risked.
Yeah, I was just going to add. Go ahead.
Yeah, so I was going to add. So, do you think that setting targets, particularly for the less experienced traders, is restrictive to their trading?
I think anything that boxes you in, there's certain things that we have that we are absolute. Like, when we we're only trading stocks that are in uptrends. Not that you can't buy stocks off their lows and value. That's a value players game, so that's a whole different game. So we're not in that area of the market, and meanwhile somebody can make a lot of money. There's great, Bill Miller is a great value investor. There's a lot of great value investors, but that's just not our game. It's not our area that we traffic in. So we're only buying stocks that are in uptrend. So that's a line in the sand. Now, once we go into a trade, we're only willing to risk a certain amount of capital. That's a line in the sand. But if we start boxing ourselves in and saying, well, if the stock goes to this point, we're going to sell, and we're not assessing the risk reward, well, then we'd be selling all the biggest winners, and probably too soon.
Yeah, I was just going to add, one of the things that I never set a stale target in the market, and I wouldn't advise anyone to do that either, because you are sort of, it's almost like you're tying one hand behind your back a little bit in terms of you want to get that feedback. So the best stock is going to blast off and look really strong right out the gate. So if you just have an arbitrary target, you're going to be selling that name too early. But what I would suggest, and what I do, is I set a lot of alarms. So I set alarms at multiples of my risk points as reference points, just to kind of see, okay, how's the name acting? Then if I'm at a multiple of my risk and the stock is extended, then I'm either thinking about potentially maybe selling part of the position, all the position, then you can sort of reassess. But, I'm always, to Mark's point, you're always thinking about, if you keep that risk reward relationship intact, good things are eventually going to happen. So I just use, if you will, target points, not to randomly sell, but just to alert me, hey, where am I potentially expanding my edge on the upside? Because that's the area I'm looking to protect. When I'm at a multiple of my risk is when I don't want to I'm certainly not going to let that trade turn into a loss. So that's where I kind of go into defense mode, in terms of my profits.
Let me just say one thing real quick. I'm sorry
please.
to hog the thing here with your asking. I know you might have questions to ask, but again, bringing up a good point. So again, this is not targets, but this is where Mark is making a very, very important point, that your goal is to take, and this is what, people who write options do just the opposite. They take a big risk for a small reward, and they have a high percentage of winning trades, but when it goes bad, it takes everything back. That's the exact opposite of what we're trying to accomplish. What we do, and what I've built my whole career on, is taking a very small risk for a large reward. Then with that, by having that big risk reward ratio or big reward risk ratio, I can now be wrong lots of times and still come out ahead. So it builds in a lot of failure. Now, once we get out of the gate, and when you first take a trade, it's all risk. There's nothing but risk. But once we get to a profit, at some point, that profit's going to get to a point where it's higher than our average gain, and it's much larger than the risk we took. So the last thing we want to do now is let that go back down and get below that average gain and go back to where we're in an inverse situation. So at that point, now we would start to protect that profit. And if you want to call that a target, looking at if it goes 2, 3, 4 times a 4-hour trade, 4 times your risk, and maybe it's your average gain is 10% and now it's at 15. Yes, we'd use that math to let us know where we are, but I don't look at it as targets. I look at it as reference points, as to know where we are and then try to improve upon them. That's what we're always trying to improve, the average gain and improve our reward risk ratio.
And I've got so many questions that have come in, but I have to ask this one at you, because this is a true trading question. You're in a profitable position. You like the name, you like whatever, instrument you're trading. I've always come to the market with the approach of I'm going to add to a position, a winning position, if I feel like it would be a good position without even having my current position on. So in other words, it would look good at current prices and I would initiate a trade right now anyway. How do you approach adding to profitable positions, or do you even?
That's precisely how I would add, and Mark will give you the same answer, that we're not going to add unless it looked like it was a good trade, even if we weren't in the trade already. So it would have to, the trade would already have to make sense. It would have to make sense from a reward risk standpoint. So we're not just blindly adding. I know some people think, and they've misinterpreted O'Neill and some of these guys that talk about, pyramiding and adding as the trade works out. Yes, to a certain extent, but not when it's extended or the stock has made a big move. And now you should be looking to nail down profits and protect your gains. So so we're only adding if it is in fact if it stands on its own as a trade, if you were coming from cash.
Great. This question is going to come to Mark Ritchie, and this is a huge question, Mark. So that's why I kind of wanted to just point this one to you. And obviously, Mark Minervini is going to want to jump into here. This is from Steve. He says, in response to a question in the Momentum Masters book on how to determine stop loss, you reply that you calculate what you would help you maintain a good weighted average win-loss relationship on your trades. Can you explain what you mean by weighted average and how you calculate this? For example, if you're giving more weight to a large position size and or more weight to a recent trade.
Yeah, I'm trying to remember exactly the context. I was saying simply your win rate adjusted for your overall adjusted for batting average win-loss ratio. So I think the person's overthinking it. What I'm really saying is I've got to keep my average loss. We're talking about stops. I've got to keep my average loss around a certain range. And long term, my average loss is right around 4%, say, in a stock trade. So if I'm not going to take, there might be a name I take with a bigger stop, but I'm going to limit that. Usually I don't even go beyond, say, 7-8%, because now I'm 2 times my average. I'm just, again, so we're talking about the math. I'm trying to let the math and the probability theory work its way into my actual trading and execution. Well, it doesn't take, you don't have to be that great at math either here, guys, to know if you take 2 and 3 times your average losses, pretty soon your average loss is going up, especially if your batting average is below 50%, which mine historically is right around 40%. So I know 6 times out of 10, I'm going to be wrong. So that's really what I'm thinking about is just how do I keep that 2 to 1? And historically, I'm about 3 to 1. So my average gain is about 3 times my average loss, and I'm right about 40% of the time. So if I'm taking a bigger stop, it's only relative, probably because the chart's a little wider, or we might be in the new a period like we've been lately, possibly trying to find a bottom, a little more volatility. but I'm still within a range that is going to allow me, even if I get hit a few times, that is not going to take my average loss and make it much larger and then start ruining my edge.
So I do want to chime in, Blake.
Please do.
So two things. One, Mark said something very important. His batting average is about 40% over the long term. So he's losing on 6 out of 10 trades. That's really important for some people to understand that. And mine is about the same, maybe between 40 and 50%. In a really good market, I might run 60, 65. In a terrible market, I run 25%. And I don't get myself in much trouble because of that risk reward. And what he was answering the question is about the adjusted. Some people don't understand the adjusted win-loss ratio or adjusting for batting average. So very simply, I mean, if you have an average gain of 10%, you have an average loss of 5%, you're 50% right. Obviously, 10 divided into 5 is 2, right? So you'd be a 2-to-1 trader. However, if you have a 15% average gain, you have a 5%, same 5% loss, now it's 3-to-1. But if your batting average is 40%, you're still a 2-to-1 trader. It's the exact same outcome. So, and your position sizing, if you use something like Optimal F or the Kelly formula, would tell you the position size the exact same. It would be 25% position size. So that's where you adjust for the batting average and, weighted or however you want to, put it. That's what we're looking at. We're looking at that net number, and that net number has to be positive, has to be where we have an edge.
Okay. This next question, and thank you very much, both Marks. This one's from Mark Minervini. And this came in way earlier today, but I wanted to make sure I tackled this because this is a good one. When do you day trade when indicated and use the daily charts, quote or parentheses, as you have said in other interviews? Are these your existing trades you are trading in because you see a spike in unusual activity or completely new opportunities?
No, usually I never day trade off of like intraday charts. Guys use 1 minute, 3 minute charts. I don't use those charts. If I am quote unquote day trading, which I wouldn't even call it day trading, I would just say it's an adjustment to the market conditions. The only time I'm going to do that is when I'm not getting the upside. I'm just simply, the breakouts are breaking out and they're not following through. And that's all that's on the table. So I'm just trying to assess what's on the table for the taking. Sometimes there's nothing. For a good part of this year, there was still a lot of short-term trading that I was making money in, and I got my return up pretty good. In the last couple of months, is terrible. It's been absolutely terrible. I've been doing almost nothing, and any trades that I am doing are very, very small. So if it's there for the taking, I'm going to try to grab it. Now, if I start taking these small profits and they start turning into bigger gains and I'm going, oh boy, I wish I held that one, and I'm seeing the follow through and more stocks are setting up, well, now I'm going to adjust and I'm going to go more into a longer term swing. And if I get the indication that a new bull market started, that's where I might want to start holding for much bigger moves, because that's where you can grab onto some of those key leaders, make those big moves coming out of corrections. So it's just an adjustment in tactics. More than anything.
Ryan, you had one.
Yeah. Firstly, I wanted to just go back to the win-loss ratio, because you mentioned that last year, and that struck me because it's something I never looked at myself. And you said, you sometimes run maybe just above 50% win ratio, but it's a case of making your winners much more than your losers. And I went and checked out my own stats, and even though I make money, I was only running at something like 51.4, 51.6% in that win-loss ratio. And that shocked me. And I think it is a good exercise for people to do. But I want to get to one of the questions from the viewers. So what's the percent risk you take when the market isn't strong? Say, for instance, 1% is your risk limit. What is it at volatile times? Does it drop to 0.25 or even smaller, sort of, if you're testing the waters?
You're talking about risk of total equity or like a stop loss per position? What are we talking
just on I believe it's on any position you take at any particular time.
Well, no matter what the position sizing is, it's always going to come back to risk of total equity, because that's the important number. What are you risking as of total equity? And our general guidelines is to start around 1.5%. And if you're not doing this for very long and you're not good at it, or you're not experienced, you probably should never go above that 1.5%. The maximum that I generally will go up is about 2.5% risk of total equity. Now, your question is putting your toe in the water, taking pilot positions and so forth. Generally start with that risk, put that risk on, but we'll have the overall exposure might be only one position, a couple positions, and go to maybe 25%. I'll just tell you the way I normally do it. Mark can tell you it's going to be similar. If I'm in cash, like now, in very few positions, I might go up to 25%. That could be one 25% position with, now and again, if you're 25% position, if you have a 10% stop, that's 2.5% of total equity. That would be that 2.5%, right? So, or I might have 5% positions, depending. If there's a lot of stock setting up, it really depends. That's going to be sort of a call that I'm going to make on the fly. But then from there, I might move to 50%. If things are working, I'll move up to 50. And then if I get some traction, I move very quickly to 75, 100, and I get aggressive very fast. So it's more of, number of positions and total exposure, and that risk of total equity stays constant unless, here's the caveat. Let's say that first 25%, I start getting clipped. And now I'm at a loss. And I know Mark Ritchie would go right here if I let him. Yeah, I start getting clipped and I'm at a loss now. Now that risk of total equity comes down. Now I start risking less. And let's say that next tranche, I get stopped, a couple more stocks, it goes down even more. And it might go down to where it's literally, very insignificant. And I'm taking just a very tiny pilot buys. So that's the key, is that if the trades aren't working, then I don't keep risking the same amount. I risk less and less and less. And just the opposite, when they're working, I start risking more and more and more. And that's the way. The key is that you want to have a strategy that assures you that you're trading your largest when you're trading your best and your smallest when you're trading your worst. And I can assure you that that sentence I just gave everybody is a multi-million-dollar sentence. This is something.
I was going to say, I've got something that I want to ask regarding that too, because that's so critical for people to, if you're jotting anything down, you should be jotting down that last thing Mark just said. Mark Ritchie, did you want to jump in there too for that?
Yeah, he stole most of what I was going to say, of course, but this is, a perfect example. The environment we've been in is exactly how an amateur that does the opposite will either blow themselves up or dig a hole so big that it feels or becomes almost insurmountable to get back, where professionals, you trade smaller and smaller and smaller and smaller, and you can come out of the drawdown so quickly that way, because you're responding to what the market is telling you. And if you start doubling up and trading larger when things aren't working, it's just a recipe for disaster. And this is true of really any directional trader, in my view, regardless of even your time frame. You have to learn how to get smaller. And then when the door swings the other way, you've also got to learn, once you start getting that feedback. I'm trading at almost meaningless size the last few months just to keep a pulse on things. But the minute the feedback gets good, I'm going to quickly move the other way. That takes time to learn. But to Mark's point, it is definitely worth the time to put in the effort in learning how to do it properly, because there is just an incredible amount of wealth to be made if you can really master that.
Blake and Ryan,
go ahead.
Blake and Ryan, I know we're talking about a lot of things here, and there's only so much we can cover in 45 minutes or so. Yeah. But 99% of all this is explained in my books. So somebody can just go on Amazon, pick up my books, and particularly the risk management sections in my first book, which David Ryan, who wrote the foreword, suggests that you should read that first. And I would say the same thing. But yeah, everything we're talking about is all spelled out, in my books. And you should also read Momentum Masters, where you have the interviews with David Ryan, myself, Mark Ritchie. So I just wanted to just point that out.
Oh, I was going to plug your book. Don't worry.
Oh yeah. All right. No problem.
But I know we just have a few minutes left, and there is no way we're going to get to every question, obviously. And multiple people have said, boy, I could listen to these two guys all day long, which I'm sure they're going to be watching this on repeat. This really last question I'm going to ask from Aditya is very important in today's environment. And I think it'd be good, because it's directed to both of you. But I'm going to add to it here based on our last conversation. What's your historical maximum drawdown from your equity highs? And this is both Marks, but I want to add to that. How do you personally, because we've all been there. I've been there. Ryan's been there. You get to that point where you're like, I'm never going to do this to myself again. But how do you personally recover after having a drawdown? Because we all get them. So let's start with Mark Ritchie. Why don't you start?
Well, early on, I would say, very early on, I had a few, bigger than double digit, almost 20% type drawdowns. But, in the last few years, very few, even over double digits. That's probably going back, I don't know, 6 to 8 years. And precisely the prior question was exactly one, how to limit the drawdown, learning that. But I think studying your results, because it's just like any strong stock chart, that is really moving in a constructive manner, you can see it just base builds before then breaking out to a new high. That's what you want your equity line to do, which is why when you're in that period where it feels like profits are tougher to come by, you've got to really dig in and think, this is where I've got to base build my equity line here, and not be even tighter with the risk, tighter with the losses, but studying periods where if you stay near new equity highs, you're in new high ground, just like a good stock, in very short order. And this is, most people don't appreciate that the wins and losses are not evenly distributed. So in the same way where I was saying, you want to saw off that left-hand side of your probability distribution, where if zero's here, I want my losses to be walled off right here, while my gains, I'll let those extend out to the right. Well, I've had periods where I've lost 10, 15 times in a row. I've had periods where I've won 10, 15 times in a row. So if you can step on the gas, how quickly can you get, can you rack up gains? And this is where progressive exposure, which we talk about a lot, at Minervini Private Access, is really important, because you only have to get yourself properly exposed once or twice to take a huge step forward. So I know, based upon what I've done in the past and what good environments look like, that I'll be in new equity highs very quickly if I keep those losses small and manageable.
You'll be in the green really quick. Mark Minervini, let's hear it from you. What are your thoughts there? Biggest drawdown.
Yeah, well, my biggest drawdowns came in the first 5 or 6 years, where that's where I blew myself up a few times, because I had no clue what I was doing. But since I, got my risk management under control and really committed to a strategy, it took about 8 or 10 years before I really, started knowing how to do what I do now, and been doing the same thing now for 40 years. In 30 years, I'm not sure. I don't think I've even had one single down year. If I have, it's been, single digits. But yeah, my drawdowns are almost always single digits. If they get into the low double digits, then I really, I go into the turtle position, I call it, and really get very conservative and just chip my way out very, very slowly. So yeah, my drawdowns are generally the largest drawdown I ever have is in the double digits, it's low double digits, high single digits. Just real quick, because people know about they can read about me and my history and my returns and so forth, U.S. Investing Championship, but not too many people know about Mark Ritchie. And again, one of the reasons why he's my co-instructor this year at the Master Trader Program, and and he works at Minervini Private Access, is because of his real life track record. And he's came to the very first Master Trader Program 13 years ago. But Mark Ritchie, again, with that 40%, really important to understand, with a 40% win rate, has averaged, for including the money that he managed, 42% a year for about over a decade, and turned $100,000 of his own money and his partner into 25 million. So, and we're not selling a product here or giving you a performance because we're going to manage your money. We don't manage any money. So I just want to make sure that's clear. This is his own personal, trading, but that's pretty impressive. I'll put his track record against almost anybody in the world. And here's the real important thing, like myself, his drawdowns during that period, he said he had a couple peak to trough drawdowns early on. He's only had a 6, a 5, and a 5% drawdown in 13 years. That's it. 3 down years of mid-single digits. So he ended up getting to the end of the year, trading his way out of that, even that in early on. If you look at I posted his track record a couple of times on my timeline, and you'll see it's way back in the very beginning, his first few years, he had that drawdown. But since then, for a decade, hasn't had any major drawdowns. So, again, the thing to glean from that is I'm not trying to say how great he is or I am. It's that you can do this too. But you have to, the key is that downside, is protecting that downside and realizing that you don't have to be right all the time. You don't have to pick lows in the market. You don't have to be a forecaster or a prognosticator that tells the future, and you don't have to be right all the time. You could, but you do have to manage your risk in relation to your reward. That's what you have to do. Because we started this whole conversation with Ryan was asking about some absolute, like sort of lines in the sand. That is the line in the sand. You have to manage risk in relation to reward.
Well, gentlemen, I tell you, it was a pleasure last time, Mark Minervini, just having you and myself getting to talk about watching you do some shooting too. That was pretty cool. But having Mark Ritchie here as well has been equally as pleasurable to all of us here at the Trader Summit community. I want to thank you both. As traders that are just now finding out about you, believe it or not, there's a couple of people in the comments that are like, wow, this is the first time I've ever heard of these guys. How do we follow your work specifically?
I'm sure there's millions of people that know me, and there's billions that don't. So lots of people that don't know us, and certainly Mark, is a newcomer to relatively to the scene, and certainly to the Master Trader program. But if you go to Minervini.com, we have the information on the workshop and so forth. And then again, you just go to Amazon, and for $29, pick up my books. I assure you, it'll be as a trader, it'll probably be the best $29 you ever spent.
Awesome. And Mark Ritchie, how about you? I just recently started following you on Twitter. Are you pretty good with social media?
More so in the last year or two. Again, now that I'm not managing any outside money, I can tweet and do some of those things on social media. And then you can hear, look, Mark and I do this every single Monday. We do Q&A just like this for all the MPA members. I think 60, 70 countries around the world that tune in every week. And we try and go through everybody's questions.
And for those who said they can listen to us all day, you can listen to us all week. In the Master Trader program, it's a week-long workshop with big long days, and we go over everything A to Z in absolute detail. And I just want to say our sponsor for that is Market Smith, who's been a sponsor for 8 years now. And they've never sponsored another event outside of Investors Business Daily. It's out their products except our event. We are the only event that Market Smith has ever sponsored that's an outside event. And we're very proud to have Market Smith. I've been using Market Smith for over 30 years.
Awesome. Well, I actually put your link to Minervini.com in the chat. And I want to thank you both for spending your very valuable time here with us at the Trader Summit community. On behalf of myself and everybody that's listening in, we're very, very thankful to have you both here. So thank you very much. And
unlike some interviews, you guys asked great questions.
Phenomenal, guys. Yeah. Thank you.
Excellent questions. Thank you.
Cheers.
Thank you, gentlemen.
Thank you,
guys. Bye-bye.
Bye-bye. Have a wonderful night.